Please make sure to subscribe. Who is Mr. Market? Mr. Market is an imaginary figure created by investor Benjamin Graham to explain the need for investors to make rational decisions in regard to their investments. Mr. Market teaches that although prices fluctuate, it is important to look at the fundamentals of an asset rather than reacting to temporary emotional responses. This concept was originally applied to the stock market, but we believe that it can be applied to all asset classes. Mr. Market creates ups and downs in asset prices all of the time, and pragmatic investors are not bothered by them since they are looking at the long-term picture. They are focused on the intrinsic value of the asset, keeping in mind that the emotional roller coaster that Mr. Market is in does not reflect the true value of the asset. Since Mr. Market is so emotional, it will offer up opportunities for investors to enter and exit at favorable times. When Mr. Market gets depressed, valuations on good assets will be favorable, allowing investors to buy them at a bargain price relative to their intrinsic value. When Mr. Market is overly confident, this may provide a good time to sell the asset at a valuation that is not rational. It should be noted that assets change over time, and therefore these are not indicators to buy or sell assets. This is an example of how prices fluctuate, and investors should maintain their assets through market volatility. This is assuming that the fundamentals are still intact. While keeping in mind the psychological component to investing, the detective work behind finding these assets is important. It is an investor's duty to identify when these assets are mispriced due to the market's emotional response. Successful investing can be difficult, but Mr. Market allows for opportunities to occur in the market for those investors who are patient. This is the great equalizer, and it provides opportunities to find great bargains. A successful investor has the ability to identify and overcome their own psychological weaknesses and ignore market fluctuations. They are confident in their investment decisions because they are able to determine the intrinsic value of an asset, thus creating a margin of safety. Please make sure to subscribe, like, and comment. We will see you soon in our next video.